Hello everyone. I welcome all of you to the 43rd session of the course Energy Law. In today's session, we will examine markets, economics and regulation. Let us quickly recap what we have discussed in the previous session. In the previous session, we examined the geopolitics of energy. We started our discussion by examining geopolitical theories in the energy context. Then we discussed oil and gas geopolitics, followed by maritime energy security. In the end, we examined specific conflicts in the energy context and discussed selected case studies. In today's session, we will examine markets, economics and regulation. We start by examining the energy market structures. Then we will move on to economics of energy security, regulation and governance, and then energy transition economics. In the end, we will also examine selected case studies. Let us briefly examine the background of our discussion. Energy systems are shaped as much by economic forces and regulatory choices as by geopolitics or technology. How states design markets, set incentives, and manage risk determines the stability, affordability, and long-term direction of their energy sectors. This session approaches energy security through the lens of economic behavior and governance, recognizing that pricing signals, institutional structures, and regulatory frameworks play a decisive role in shaping outcomes for both producers and consumers. In an era of rapid transition and volatility, these economic and regulatory dynamics are becoming more influential than ever. Let us examine energy market structures. Energy markets, be it oil, gas, coal or electricity, are shaped by unique structural, physical and geopolitical characteristics. Unlike ordinary commodities, energy markets often exhibit high capital intensity, infrastructure lock-in, and strategic state oversight. Let's have a glance of spot versus long-term contracts in LNG and oil, cartel behavior and price manipulation theories, and electricity market reorganization. Energy markets broadly operate through two modes of contracting: spot markets and long-term contracts. Spot markets, we can think of short-term price-based trades. On the other hand, long-term contracts are multi-year agreements with stable volumes and price formulas. And specific characteristics of oil markets include the flexibility, financialization. For instance, future markets influence pricing via speculation, hedging, and derivatives. Oil markets are highly flexible and global. Crude oil is fungible, easily shippable, and traded through liquid spot markets. For instance, Brent, WTI, and Dubai benchmarks. Oil spot prices react immediately to geopolitical shocks. For example, we may refer to Gulf wars, sanctions on Iran, and Russia-Ukraine conflict. On the other hand, liquefied natural gas markets historically dominated by 20-25 years long contracts with destination clauses, oil index pricing, and take or pay provisions ensuring guaranteed offtake. There are two important points. Spot markets offer flexibility but create price volatility. Secondly, long-term contracts provide stability but reduce bargaining power and flexibility. The next point for our discussion is cartel behavior and price manipulation theories. Energy markets often feature oligopolistic dynamics rather than perfect competition. Cartels seek to restrict supply to manipulate price, and the stability depends on coordination and enforcement. In some cases, for instance, Saudi Arabia acts as a swing producer, absorbing production cuts to stabilize the cartel. OPEC Plus, including Russia, introduced a broader producer coalition capable of influencing global supply, stabilizing or elevating prices, and responding to demand crisis. The various dimensions of price manipulation and market power are joint profit maximization, leverage through market concentration, predatory pricing, and political pricing. For joint profit maximization, producers act collectively to set prices above competitive levels. For gaining leverage through market concentration, few large exporters control pipelines, LNG liquefaction capacity, and shipping fleets. We can also see large exporters gaining leverage through market concentration. As we already discussed, few large exporters control pipelines, LNG liquefaction capacity, and shipping fleets. Cartels and oligopoly behavior can affect price stability, vulnerability of import-dependent states, and competition policy and market regulation. Another significant point for our discussion is that of electricity market reorganization. We will see unbundling, competition, and market coupling aspects. Unbundling is driven by global liberalization trends. We can see ownership unbundling as well as legal and accounting unbundling. In ownership unbundling, generation, transmission, and distribution separated into independent companies. However, in the case of legal and accounting unbundling, vertically integrated firms retain ownership but operate separate accounts and governance. For example, the Electricity Act 2003 unbundled SCBs into GenCos, TransCos, and DISCOMs. While examining the competition aspects, we can see that wholesale electricity markets are reorganized into day-ahead markets, intraday markets, and capacity markets. We can also refer to retail competition in countries like the United Kingdom, Australia, and parts of the European Union. The benefits of competition include lower prices through competition, innovation, and renewable integration. Market coupling aims to integrate regional power markets using harmonized rules, coordinated cross-border trading, and shared capacity allocation. For example, we may refer to the European Union's internal energy market, characterizing day-ahead coupling across 27 countries. Market coupling is highly significant from an energy security point of view. It characterizes enhanced grid resilience through diversity of supply, ability to absorb intermittency from renewables, and reduce price volatility due to larger balancing areas. We can see that energy market structures, whether through contracts, cartels, or market reforms, directly shape national energy security, influencing price stability, supply reliability, investment flows, and geopolitical vulnerabilities. Let us examine the economics of energy security. Energy security is deeply intertwined with macroeconomic stability, long-term development planning, and the structural health of national economies. Economic approaches to energy security highlight how supply disruptions, price volatility, and resource scarcity can trigger broad system impacts. Let's start with the HRSG report. The HRSG report, commissioned by the US Department of Energy, remains one of the most influential economic analyses of long-term oil scarcity. It examined the concept of peak oil, the point at which global production reaches its maximum and irreversibly declines. That means, peak oil is the theoretical maximum point of global oil production, after which extraction rates will steadily decline due to resource depletion. The underlying idea is that oil is a finite, non-renewable resource. As easily accessible reserves are depleted, remaining reserves become more difficult and expensive to exploit. Some argue that technological progress such as fracking, deep water drilling, or enhanced recovery delays peak oil, while others emphasize geological limits and rising extraction cost. Peak oil can affect energy security in multiple ways. Declining production can lead to chronic shortages, making oil importing countries more exposed to market instability. Higher competition among states for remaining reserves increases geopolitical tensions. As supply tightens, prices become more sensitive to political events, conflicts, sanctions, or natural disasters. Sustained price hike can strain national economies, especially those heavily dependent on imported energy. Another consequence is that of increased dependence on unconventional and high-risk sources. The peak oil challenge highlights the finite nature of petroleum resources and the potential decline of conventional production. Its implications for energy security include supply instability, price volatility, geopolitical risk, and economic vulnerability, making diversification, strategic reserves, and clean energy transitions essential policy responses. The HIS report also highlights certain important points. The report says mitigation requires 20 plus years of preparation. The report warned that without early action, societies would face severe economic dislocation. The report observes that oil is embedded in all sectors. For instance, transport, petrochemicals, agriculture, manufacturing, and defense, and so on. The report highlights that transition costs can be enormous. Rapid declines in oil supply could trigger sharp price spikes, recessionary pressures, trade imbalances, and inflation in essential goods. From an economics point of view, the next aspect is that of price volatility and macroeconomic stability. Energy prices, especially oil and gas, are highly volatile due to geopolitical shocks, supply chain disruptions, speculative activity in future markets, cartel behavior, weather events, and shifts in global demand. Price hikes can directly contribute to increased production cost and reduced household real income. Strategic petroleum reserves play a significant role in this context. Strategic petroleum reserves are government-controlled stockpiles designed to buffer against major supply shocks. They represent the classic economic tool for preventing crises from translating into macroeconomic instability. Functions of strategic petroleum reserves include emergency supply substitution, price stabilization, and geopolitical leverage. Countries with reserves, for instance, the United States, China, Japan, and India, can negotiate better with producers. We can see that energy security is fundamentally an economic security issue, and long-term stability requires diversification, resilient markets, investment in alternatives, and robust emergency management system. Let us examine regulation and governance. Energy security is not only shaped by markets and geopolitics, it is fundamentally an outcome of regulatory design, governance capacity, and institutional choices. States intervene heavily in the energy sector through subsidies, pricing rules, environmental standards, trade measures, and renewable energy obligations. Good governance can reduce vulnerability, while weak governance amplifies shocks. The types of energy subsidies include consumption subsidies, producer subsidies, renewable energy subsidies, and cross-subsidization. Consumption subsidies include lowering retail prices of electricity, LPG, diesel, or kerosene. Producer subsidies include tax breaks, royalty reductions, and capital incentives to fossil fuel companies. The various types of renewable energy subsidies are feed-in tariffs, viability gap funding, accelerated depreciation, and capital subsidies. Domestic regulation is central to shaping markets and improving energy security through diversification, efficiency, and competition. Domestic regulatory tools include renewable purchase obligations, demand-side management regulation, and open access regulation. Renewable purchase obligations set legally binding targets for DISCOMs, industries, and open access consumers to procure a minimum share of electricity from renewables. The various instruments are RPO trajectories, renewable energy certificates, and green open access rules. This will enhance energy diversification and support renewable markets and reduce import dependence. Demand-side management tools include energy efficiency mandates, smart metering, time-of-day tariffs, and behavioral nudges to reduce peak load. This has an increased impact on energy security as DSM tools reduce peak shortages, cut import bills, reduce stress on grid, and delay expensive capacity additions. Open access allows large consumers to buy power directly from the market or independent producers. There are multiple benefits. Open access increases competition in electricity markets. Open access encourages renewable energy procurement through green open access. Open access also reduces the monopoly power of DISCOMs. Let us examine energy transition economics. We can start with the stranded assets theory. Stranded assets refer to fossil fuel reserves, infrastructure, and carbon-intensive facilities that lose economic value before the end of their expected life due to climate policies, market shifts, or technological change. As renewables become cheaper and governments impose stricter climate regulations, coal mines, oil fields, pipelines, and thermal power plants risk premature write-downs. This creates macroeconomic financial risk. Banks face exposure to carbon-heavy portfolios. Utilities grapple with balance sheet pressures. And fossil fuel dependent economies confront long-term fiscal instability, and so on. Avoiding fossil lock-ins requires careful planning of energy investments, phase-out pathways, and just transition mechanisms for affected communities. Carbon pricing is a central tool for internalizing the negative externalities of emissions. Carbon taxes provide price certainty by imposing a fixed cost per ton of carbon dioxide, incentivizing both efficiency and fuel switching. Emission trading schemes, notably the European Union ETS, set a cap on total emissions and allow trading of allowances, creating a market-based price for carbon. Many countries combine ETS with complementary instruments such as renewable portfolio standards, performance standards, and green industrial policies. It's also interesting to note the global energy investment trends. International Energy Agency projections show a structural shift from fossil fuel dominance toward clean energy. Investments in solar and wind now surpasses investment in oil and gas exploration in several regions, driven by falling technology cost, policy incentives, and corporate net zero commitments. The global push for electrification, electric vehicle, heat pumps, digitalized grids requires massive capital in grid infrastructure and storage. However, the pace of investment remains uneven. Advanced economies and China lead while many developing countries face high financing costs and limited access to climate finance. IEA scenarios emphasize that meeting Paris Agreement goals requires tripling renewable energy investment, scaling up green hydrogen, and aligning financial flows with long-term decarbonization pathways. Let us examine two selected case studies. India's strategic petroleum reserves and crude diversification strategy, and Germany's Energiewende and its cost debates. India has established an SPR capacity of approximately 39 barrels. This is distributed across dedicated facilities in Vizag, Mangaluru, and Padur, with additional phases of expansion currently being pursued. The SPR serves as a critical safeguard against external supply shocks, market volatility, and geopolitical disruptions. India has also undertaken a deliberate strategy to broaden its crude sourcing beyond its traditional reliance on the Middle East. Its important basket now includes substantial volumes from the United States, Russia, Latin America, and West Africa, reflecting an effort to mitigate geopolitical exposure, enhance bargaining leverage, and secure more favorable pricing terms within an increasingly complex global energy landscape. Germany's long-term transition strategy Energiewende centers on phasing out nuclear and coal while scaling up renewables. Solar and wind now constitute significant shares of electricity generation, but the transition has faced criticism due to rising consumer electricity prices, heavy subsidies under the EEG surcharge, and grid constraints. The premature nuclear phase-out intensified reliance on imported gas, exposing vulnerabilities during the 2022 Russia-Ukraine crisis. Debates persist whether energy vendor strikes the right balance between climate ambition, affordability, and energy security. Let us conclude our discussion. Energy security ultimately hinges on how markets are structured, how prices respond to shocks, and how regulators balance combating pressures. The interaction between spot and long-term contracting, the behavior of producer cartels, and the functioning of reformed electricity markets all shape resilience in practical ways. Economic tools such as strategic petroleum reserves, subsidy reform, and carbon pricing mechanisms further influence both stability and transition pathways. These dynamics reveal the central role of institutions and incentives in determining the sustainability and reliability of modern energy systems. Let's see what's coming up. The upcoming session will explore energy transition, technology and security, focusing on how emerging technologies are reshaping energy systems and the new security considerations that arise as states and companies navigate decarbonization pathways. We will also look at geopolitical implications, supply chain vulnerabilities, and the governance challenges posed by digitalization and critical minerals. Thank you.